Welcome back, and thank you for jumping back into Lamb's Cryptoverse. Today we're going to do something different. We're going to do the chart of the day, and it's not going to be the typical chart that you're thinking about. It's not going to be the typical chart that everyone's talking about in the news. For example, everyone's talking about the Consumer Price Index. Today they talked about the University of Michigan Index, and they're talking about GDP. We're going to talk about why the Fed needs to raise interest rates, and it's not what you're thinking about. Let me show you. If you look here, this is why the Fed needs to raise interest rates. Because the 10-year real interest rate is too low. Now, you might be saying to yourself, wait a minute, it's gone up dramatically. It was minus 35 basis points, and now it's 121 basis points, basically 1.21%. So it's gone up dramatically. So you might be thinking, why does the Fed need to still raise rates? It's because if you're looking at this alone, it looks good. But here's the problem. You got to compare the real interest rate with the Consumer Price Index and with the 30-year constant maturity and the 2-year constant maturity. In other words, you need to compare the real interest rates with other rates. And here's the deal. Real interest rates, in case you don't know, are interest rates after inflation. So you take, like in this example here, the last rate is, maybe we may use round numbers. This is 8.25. Let's say 8%. And let's use one of these. The 30-year rate is at 4, right? 3.97. So that's 8 minus 4. So that's a negative real rate, minus 4%. You see what I'm saying? The real rate has to be positive. So here's why the Fed needs to raise rates. This is the one thing you need to know. If you look at the green line, that's the Consumer Price Index. Now notice the red line and the blue line are usually almost always, and this data goes back to 1977, those two lines, the 30-year rate and the 2-year rate, those rates are always above, almost always above inflation. And what does that mean? That means the real rate is always positive. So you can't just look at this chart here that I showed you, the 10-year real interest rate, because these numbers look high back here in 1990. We're about 4%. You're like, wow, that looks really good. You cannot look at this rate alone. It has to be looked at with some form of inflation indicator. In this case, this is a CPI. So this is why the Fed needs to raise rates, because if you go back here, when the rates were really high, notice even though inflation was high, at some point in time, many points in time, you see the red line? The red line, that's the 2-year rate. The 2-year rate, I'm going to put my mouse on it, hopefully it won't move. The 2-year rate was at nearly 17% at one point. But it was higher than inflation. And if you look at this period here, sorry for all the mumble jumble here, but let me just talk to you about it. If you look at the period between 1980 and 1985 or 1990, those rates, those market rates, 30-year rates, the 2-year rates are much higher than the CPI. Now, if you look here into recent history, and I could zoom into that if you want to look at it closely to the last year or two, look at that. That is dramatic. There's a huge, huge difference, probably the largest difference in history, where the Consumer Price Index is much higher than any of these market rates. So that's why the Fed needs to raise rates. I hope you enjoyed this channel. And if you want to see more of this, please leave it in the comments or please like us.